This will be a podcast in about a week or so on all your favorite platforms, as well as available on YouTube. And I'm going to say it up front in case Twitter does go down. I am also on Instagram, Facebook, and pretty much every other major social media platform. Unfortunately, nothing is quite like Twitter when it comes to FinTwit. So hopefully Musk will be able to pull it off, although I think it's going to be rocky here. I'm excited for this conversation with TX. I've been reviewing some of his prior spaces, some of his tweets. I think we're very much aligned in the way that we look at markets. So maybe a bit of confirmation bias, but we'll see if we can get some good back and forth here. My name is Michael Guyot, publisher of the Lead Lag Report. Joining me for the hour is TX, who I know, TX, you want to be a little bit on the anonymous side here, but introduce yourself. Who are you? Why are you qualified to talk about markets, and what are you doing with some of your research?
Sure. Thanks for having me, Michael. Been looking forward to talking to you. I enjoy listening to your spaces. Yeah, so I would consider myself an independent researcher. I don't manage money. I manage my own funds. And I don't know that I'm qualified necessarily in any extent that anyone else is. I'm an active participant in the market. I try to be data driven and rational in my approach. And my content really just sprung from my own desire to better understand these markets. I'm teaching myself. And I don't have a background in finance. I do have a background in data analysis, which is where I learned how to make charts. But the crux of my content, like I said, is really just a desire to really explore and understand this complicated market that we find ourselves in. It really feels like we're at the apex of like a long-term cycle in a lot of ways. And the content is an output of those things. So people have found it relatable, and I'm apparently enjoying it. So I'm going to continue to produce it. But that's mostly where it all comes from. And so I don't know. This is the best way to summarize what I do.
How long ago did you get interested in markets?
Well, it was a few years ago. It was about 5 or 6 years ago. I decided that I was going to become a great day trader. And I was going to start learning how to day trade. And I did all the cliched things that a person does. They buy courses and they watch YouTube videos about candlestick patterns. And I did all of that shit. And, I had mixed success. But then I went through some personal family struggles for a couple years, lost both my parents in close succession, and really started to take a look at what I was doing and how seriously I was taking any of this with my future. I was never someone who really felt like there was a career that I wanted to have. I just wanted to have ownership of my time, And so as I grew up, I never really pushed myself to go down any particular path, to finish college, et cetera. I always kind of bounced around. But I found myself drawn to the markets, to the kind of potpourri of human psychology that make up the bids and asks and the battle over price, and how those things really tie into the economy and the way people live their lives, current events. I've always found all those things fascinating. And so even though my day trading wasn't really successful, I wanted to continue learning about the markets. Obviously then COVID happened. The world kind of changed overnight in a lot of ways. And that's when my education and my personal drive to learn more really accelerated. But I didn't join Twitter until April or May of last year through the encouragement of one of my friends who knew that I was following the markets. He's like, you should start putting out charts and posting about it. So I did, and it's led me here. I don't trade as much as I used to. I just kind of manage my money. I realized I'm not an amazing day trader, but that doesn't stop me from wanting to study the economy, better understand it, try to navigate through the murk, as I like to say. So it's been about a 5 or 6 year journey to get where I am here.
And my condolences for your loss. I mean, I'm public always about my father's passing many, many years ago, and the pain never fully goes away. So condolences on that. Okay, so a couple of things. So you talk about you initially were focusing more on the day trading side of things. It seems to me that there's an impression that day trading is the way to generate profits, even though you and I both know there's overwhelming evidence that suggests that that's not the way to generate longer term returns. And FinTwit, I think, is increasingly more short term. Everyone seems to want to view things from the lens of day trading, not necessarily having an investment thesis. What is it about day trading that you think causes people to gravitate towards it? Is it just the seductiveness of quick gains? Is it that it seems like it's easier? What is it that brought you? What was the siren song for you when it came to day trading?
Yeah, there has been a big surge for it in the last few years, and it went into hyperspeed after COVID when everyone got sent home and was given a bunch of extra money, and they couldn't spend it on the services sector. So the it really drove the people's interest in the markets heavily there. And if I had to pin it to something, I think that it would have to really come back to what's going on with the money in general, right? With the rapid debasement of the currency over time. And it's lowering, I mean, rather, it's raising of people's time preferences, right? It's moving people's need to have satisfaction and relief further into the present. It's pulling it forward. It's pulling all of that demand and need and expectation forward. We see this also with the digitization of everything, with the proliferation of social media. Everyone's time preferences, their attention spans are shorter. Everything's happening in shorter cycles. And I think that people in a lot of ways are feeling it harder and harder to keep up, so to speak. No, there are measures that could suggest Americans are doing better than they ever have before on a long-term basis, right? But there's still that feeling of, there's pervasive inequality, and there's also that desire to want to get ahead. We've had kind of suppressed wage growth for many years before the recent last year and a half. And so I think you combine a lot of those factors together, along with the just changes that happened in the economy in 2020 that accelerated that. I think that you can see where people would find it attractive to jump into something like day trading, especially now when you have so much information. It's so ubiquitous, right? Like I could go on YouTube right now and literally learn how to day trade. You might not be good at it. Obviously, there's a lot of work and time and screen time experience. You have to have a strategy and an edge, but you can learn how to do it. That information is there. Whereas before, you would have to exercise more effort to get access to it, probably at more cost. So I think that it makes it appealing to people. There are people feel like they can become an expert at something, or at least skilled at something on their own in a lot of ways, be autodidactic in that way. And so I think that you look at all of that, and it makes sense that people would gravitate towards day trading and just short term gains generally.
Yeah, and I think you hit on it a little bit earlier too, right? I mean, it's very much related to attention spans shrinking, and it kind of makes sense, right? I mean, it used to be the case that the average holding period for a mutual fund was like 4 years. Now with ETFs, it's probably like more like 4 or 5 months. Individual stocks less, and then obviously get down to the day trading side. Now I'm curious because you mentioned that you have a background in data analytics. When you think about that experience trying out day trading or trying to be a successful day trader, did it put you in a little bit of a state of cognitive dissonance? Because when you're a data analyst, I'm assuming, need to differentiate between signal and noise, and there can be a lot of noise and randomness when it comes to daily price movement.
There can be a lot of noise in daily price movements. And what happens in day trading, depending on what part of the market you're focused on, the behavior in that market that you see on a given day could be completely dislocated from the narrative in the broader market and the behavior in the indices. Like when I was focused, my strategy really was around small caps, a lot of biotechs, really low cap stuff like below 40 million float type of things. And that those things move almost every day. There's something that can rip, 20, 30, 50% in the pre-market on idiosyncratic flows while the rest of the market looks like crap. And so that can be a bit dislocating. And as well, there's just a lot of noise and movement, particularly after the bell. When you see the volumes increase, there can just be a lot of noise in there. I tended to focus more. I like to watch the tape, to read the level two, and to have as simple of a visual chart as possible, because anything more than that I felt was noise. But if I could take quick trades, hold times of less than 2 minutes, 3 minutes in a lot of cases, then I felt like I could find edge in the flows, in the momentum in and out of price. But it is really jarring. And I found the main reason I wasn't really successful at day trading when I gave it a shot, and I've pulled back. I've been interested in getting back into it though, actually. I just kind of feel that itch, is because it's a personal journey, particularly when you're making decisions in that short of a time frame and the response that you get to your decision making is that fast. You go on a personal spiritual journey with yourself, your ego, and your flaws at light speed. And so I wasn't fully prepared for that experience until I got into it and I was waist deep in it before I realized, wow, I need to take a step back and maybe do some personal searching as well as trying to learn this trade because it really is a psychological game in a lot of ways.
I think it also gives people maybe a bigger sense of control, right? The shorter term you are, the more it feels like you can control the outcome. And that's a really, I think, interesting dynamic as far as how that interacts with volatility in markets, right? Because listen, somebody can claim to be a long time investor and believe in buy and hold and show you all this longer term data, but the moment they start going through some volatility, they maybe start acting differently. And I'd argue that's where maybe you get more day trading type activity.
In periods of higher volatility?
Yeah, I don't know if there's any real data behind that, but because the higher volatility makes people feel like they need to have more direct control rather than be swung around by the market's movements.
Yeah, I think it's possible, though. Usually in these periods of higher volatility, the average volume is lower than in periods of just kind of a general uptrend. But that also creates less friction in the books, and it can maybe make it more seductive for somebody who's trying to get in and out really quickly.
Yeah, no, that's fair. Okay, now you mentioned that you turned to some YouTube videos, and I like that point you sent me on DM that for you it's always about wanting to constantly learn. I always make it a point that whether you're an amateur or a pro, we all have the same problem, which is that we can never learn enough. How do you what sources of information did you in the initial stages of your investing journey turn to? Because the problem, as you know, also with YouTube and some of these kind of short form videos when it comes to understanding investing, is that those making the content may not really understand investing themselves, right? They're all kind of regurgitating the same visual descriptions of why markets do what they do.
Yeah, and a lot of it is really overly packaged, and they come up with a lot of terminology for really basic market behavior to try to make it seem kitschy and exclusive. And it's really just a way to separate fools from their money. There's good content out there about just the basics of how to read a chart, which I think is a barrier to entry for a lot of people. But I think there's very little substitute for the actual experience of having money on the line in a real environment. There's only so much watching on YouTube that you can do before you actually need to try to take a trade and record your experience and have something to feed off of. So that's where most of my learning has come from, and I think it's also really valuable to have a friend or to find a friend who is also interested in the markets in the same way as you, who can kind of check your biases and who can find things that you're not looking at because there's too much to follow. And so that's been really helpful for me. It's helped me to get closer with an old friend that I got separated from for many years, when we both found that we follow the markets together. And when if you read Howard Marks or you read Warren Buffett, they all have a friend, right? They have a close confidant in the markets with them that they talk to regularly, that helps keep them grounded. And so that's actually, I think, one of the most important things to success, frankly.
Yeah, you need to have that support system, and Twitter and other social media networks can be helpful with that, but it's always better to have somebody that you actually know in real life, right, to kind of help you through that journey. Okay, so let's go back to the data point I shared in the nest, a tweet that you put out looking at the Dow Jones Industrial Average going back to 1896 inception, and showing something that I've been stressing as one of the anomalies this year, which is that one thing is to say that stocks and bonds lose money, another thing is to say how they interact with each other and how they, as a standalone, are behaving. This year is remarkable, not only the fact that the real returns for the equity market are on par for the worst in history, but also the way the market has gone down is historically abnormal. So I looked at it from the S&P perspective. You go back to 1931 was the only other time where the percentage of weeks where the S&P is negative was as high as percentage of the year as this year. So that's the whole staircase down argument. You did it on the Dow Jones Industrial Average. I'm curious to hear your thoughts on the sequence of returns this year, because I think this is where a lot of people are underestimating just how difficult 2022 has been.
It's been difficult to read for sure. Like you just said, this is for the S&P one of the worst years in history in terms of red weeks as a percent of the year. The Dow Jones, if 4 of the next 6 weeks are red, it will be the worst year in 127 years of the index in terms of red weeks as a percent of the year. And we don't have a recession to show for it, right? Which is very interesting. And
But I'm glad you said about it, because that's why it's so using. I've made that point before. It's like, so you have this path which is so abnormal. The only other time it happened was 1931. We're not in a depression, so there's something really bizarre happening here. Just
there is, yeah, there's some kind of a distortion there, and I don't know that I have all the alpha as to what exactly it is, because this so far for the S&P, this was the third worst drawdown without a recession going back to the beginning of last century. The only other times that we had a steeper drawdown outside of a recession were 1962, the Kennedy slide, and 1987, the flash crash. Both of those are characterized as flash crashes. So the fact that we have that this year, but no one could characterize this as a flash crash. It's an 11-month slide. It is remarkable, and in some ways, this time is different. Though it isn't.
Yeah, well, so it's different in the sense that it's what I've argued and still argue, that from a data set perspective, this is very much an anomaly of a year, right?
Right. And your treasury argument is one of the key signs of that. The fact that both bonds and equities have sold off as much as they have in tandem, that never happens.
Right. And look, the other part of this is that the number of weeks that treasuries have lost money in price, risen in yield, is, last I checked, 74%, which is the most ever in history. So now you're kind of putting together multiple outliers, right? Not only is there an outlier where treasuries have lost more than stocks in a big stock market drawdown, but stocks as a standalone have an unrelenting number of weeks lower, and treasuries as a standalone have an unrelenting number of weeks lower. This is what FinTwit is not really fully, I still think after all this time of me trying to hammer this point, is really appreciating. Now, the question, of course, as you know, from a data perspective, yourself, from your way of thinking about things, is what do you do with that data? Do you try to change your approach, or do you simply wait through it? My response is you have to wait through it, because you don't know exactly when it ends, and maybe by the time you've identified the anomaly, it's near its end anyway. But how do you think through that aspect of, when you're in a clear anomaly from a trading and investment perspective, what do you do?
Right. That is the question. And, some people have to put a trade on, right? Because they're managing someone's money. They're expected to have a position and an insight. So they have to put on a trade of some kind. Whereas I have the luxury of choosing to not participate in the market for a given period of time, which is what I'm currently doing. I'm pretty much just in cash, and I maintain a position in Bitcoin because that's part of my investing strategy. But it's not something, most of my assets are cash, and they have been for months now. And I will probably remain that way until I feel like we're starting to see a bottom form in equities. And just based on the kind of sequence of events that typically plays out, there's someone on Twitter, Michael Kantrowitz, who I think you've had on your spaces before. He calls it the hope cycle. We're only halfway through the sequence of events of a typical bear market. We haven't seen earnings respond at all, and we haven't seen employment respond really at all to the tightening that has been going on since March. We've already seen housing slow down. We've seen new orders slow down. And there's other elements of the economy that show weakening. PMIs have dipped negatively, and manufacturing PMIs are negative. But there's also still a lot of other resilience in the economy, particularly on the labor side. Consumption hasn't really been hit because they're not directly hit by interest rates. So because of the uncertainty with all of that, because it's hard to say that we've formed a bottom yet, I have the luxury of choosing not to actively participate in the market. So that is my current position because of what you just listed, and because of what I said.
Yeah, and that's always a big distinction too. I mean, this is where retail, as long as it's thoughtful analysis, not based on memes, right, it does have an advantage over guys who are managing to prospectus, right, that have a very particular approach, that have to follow the approach irrespective of the cycle. And this has been, I've said this many times before, it's like this has been hell, right, from a lot of different perspectives. But hell eventually ends, and the question then becomes, when do you start transitioning to a more hopeful environment from a retail perspective to deploy capital?
Yeah, that's a good question. And the last few months, I haven't really been changing my positioning in any way, or taking any kinds of trades, or really changing my investments. They've been relatively static since earlier this year. I do employ, like, I look for support and resistance levels, and try to time an entry if I think that we're, reaching an ideal spot to take a position. But I don't change my investments a whole lot. A lot of my research is really driven because I just find all of this fascinating. I want to share what I'm learning. I want to better understand it. There's a lot of people that are much smarter than me who follow me. And in a lot of ways, I hope that I put something out that's just flat wrong and they tell me why that's true. That hasn't, that hasn't happened very often. But I really am just trying to engage with others and try to better understand things so that maybe I can become a more skilled investor, so that maybe I can build some actual wealth and take better control of my future. Because I'm still very unsatisfied with my personal attainment of wealth so far, right? And part of that is because I wasn't able to really make it as a day trader. But I can do analysis. And I guess throughout this journey, I haven't yet, with full transparency, I haven't really found a way to marry what I understand about the macro economy and my research there with the actual nuts and bolts of buying and selling and taking positions in the equities market and in whatever market. Those are hard
I want to
concepts
expand
sometimes
on
to
that.
marry.
I want you to expand on that because this is I keep that hits on something I keep saying, which is that people often talk in terms of macro endpoint, but the path in between is what matters, and it's hard to marry a macro view with a buy and sell entry and exit point.
It is, right? Because macro is not what's happening to the market right now. Like, I haven't even looked at the stock market this morning because and it's not going to change any of my macro analysis, right? So the those things are not one to one. There is an air gap there. There's a time gap there, and so you can see the fundamentals of something changing. It can alter your thesis and your desire to invest or not invest in something. But then it becomes attacking it as from a positioning standpoint, finding the ideal entry, seeing it at a point of weakness, and then dialing into the time frame that you want to buy in, right? Like, some people just buy at the end of the day, some people want to get in there intraday, find a moment of weakness in the price. And so that really comes down to your skills reading the price charts and your, being an active trader. But there is a comprehensive gap between reading economic data, understanding what unemployment rates and the labor force means, and business investment and GDP, yada yada. You can read about all those things and understand all of them, but have no skill whatsoever when it comes to buying and selling assets and equities and things like that. So they are difficult strategies. They're completely different skill sets in a way, though they can be complementary. And the people who do it best are the people who understand both of them and have found a unison between the two. Good question. And I fully agree with Michael on the value of FinTwit. This is an incredible section of Twitter, which itself is an amazing platform. Like, nowhere else in the world can you find this concentration of subject matter experts who are accessible, willing to communicate, and all in one place. Right? It's really fascinating, and that's how I've leveraged Twitter from the beginning. One of the first people I ever DM'd was Balaji. I DM'd him directly, and he responded to me like in the first week that I had a Twitter account. And that's how I've just maintained my approach. I just reach out to people. I send DMs to Lynn Alden and just whoever I want to ask questions to. And many people respond. It's amazing. And so, in terms of my input output, I would say it depends on the subject matter. Certainly, there are things where I feel like I can contribute more to the content on Twitter than what I'm seeing. Like, my initial focus when I first started putting out content was really focused around Bitcoin specifically. We were in the middle of a bull market. I was doing a lot of on-chain analysis, and I feel like I was providing a lot of content that no one else was providing. But when this year, when the macro picture really took the reins from everything, and it became more prudent to start focusing on the economy and the surrounding markets and not focus on Bitcoin and crypto, I started siphoning more from the community. I started paying more attention to other people's content, and it became more of like a 50-50 split, I would say. I get inspired by what other people put out, and that will give me an idea. Oh, I don't really understand what this metric is. Let me go see if that public data exists somewhere. And during that journey, I end up finding other things. I have a passion for data visualization. Most of my charts I build in Tableau, which is some enterprise visualization software I use. And I find a lot of my insights just poking around. Like people will post about US Treasury holdings a few months ago. I had no idea that foreign holders of US Treasuries had a public database held by the Treasury. I didn't even know that existed 6 months ago until I saw someone post about it on Twitter. And now I have an entire data set of it that I've pulled myself and that I maintain. And I build insights now because of it. So it's definitely a shared system. And I try to participate actively in it because when I pull away from it and I'm not engaging with other experts, like some of the people I see listening to me talk right now are subject matter experts in things that I wish I knew much more about. And so I really take a lot from this community. And I think that it's necessary, frankly, not just because of the complexity of the current situation we're in, the current environment, but also because it's impossible to be an expert on all things and to follow all things. So that's a long winded answer. I hope I answered you. Right. No, that's a good question. So in terms of not like nibbling on equities, part of that is because I just don't currently have a base case that the bottom is in. I see pervasive evidence that it isn't so far. So I believe that there's still a further to go, and until I feel better about that, I probably won't consider buying back into any equities. And I'm not even a great stock picker, so I couldn't even tell you what I would look at there. But the being in cash, I think, is prudent. I mean, if you just look at what the DXY has done this year, and with the Fed being so overly aggressive compared to their peers, it makes sense to have a sizable cash position to me, not just to be flexible, not just for emergencies, but because it's outperforming most other assets this year. So I just been sitting in stocks.
The best inflation hedge ended up being the dollar. The irony.
Right. Yeah. The best performing asset of the year ended up being the dollar. Crazy. But I also, the point you mentioned about why not maintain a position in something you feel the fundamentals are really strong in. I would argue that the fundamentals of Bitcoin are very strong, but the environment around it is not supportive and accommodative of its price. And so that's why my position is not outsized. And that's why I probably would recommend extreme caution to others who are looking to start a position here, who don't know what they're getting into. But I've done extensive research on it. And where it is now, the fundamentals are significantly improved. It's just the price represents the macro environment. And, Bitcoin thrives when credit creation is accommodative, when money is easy, and it doesn't like high interest rates. So I'm waiting for some of those conditions to begin to change, and I'll probably increase my sizing in Bitcoin.
Let me reset the room for the remaining minutes here. Everybody, please make sure you follow X here on Twitter. Also has a really good YouTube channel that's getting some nice traction. Again, this will be available as a podcast under the Lead Lag Live banner. Let me turn that into it just because I think it's an interesting direction to go. So let's assume for a moment, TX, that recession's in, the damage is done, which is certainly my thesis, and I'm with you that the bottom is not in for the stock market. Presumably, we're going to have a little bit of a repeat of something like what we saw with the COVID lockdowns, meaning people are unemployed and they might feel the desire to try to take a stab at markets again. And this goes a little bit to the self-learning journey, TX. What do you think people should be doing if they have that mindset, if they're starting to worry about income, or they're starting to worry about their jobs no longer being in existence?
Well, that's tough. And, I don't always feel like I, can provide people that kind of advice, right? Because it's such a deeply personal thing. And if we're going to, if a recession is if a person believes is likely, then I don't see why there would be an urgency to try to participate in the markets and to get in here. I think it's much safer and more prudent, considering where we are in the long-term debt cycle, considering the outsized impact monetary policy has on the markets at this stage. I think it's much more prudent if someone has no exposure, no experience, they are green as the grass. It makes much more sense to save your money, to try to protect yourself for whatever downside risks there may be, which seem outsized at this time, and wait until market conditions are more accommodative. Who knows if that is next year? We'd like to believe it is. There's a lot of people who thought that conditions would have already reversed by this point. I remember there being an outsized group of people on Twitter who thought the Fed would pivot in September and the liquidity lottery would resume again, and those people were dead wrong. So I think it's far more prudent, especially with the magnified level of uncertainty, not to try to get cute with participating in a specific market or thinking one asset class that's going to outperform when virtually all assets are correlation one in this market. So that's generally my approach. I think people who have their own edge and their own experience, they're not looking to me for advice in the first place. So I'm not really talking to those folks. But if the question is, I want to get into the markets, I think this might be a place where I can increase my wealth. I think this might be a place where I can create more financial freedom. It's begin your education, certainly. I wouldn't make that the focus of your energy at this current stage until it starts to look like the light at the end of the tunnel is getting brighter.
Speaking about massive uncertainty, I'll go to Chio in a second, but I want to get your thoughts on FTX because I feel like everyone is talking about it, and all these Twitter spaces are nothing but what's going on with FTX. But the question I want to go with FTX is something which I keep alluding to, which is to me it's a low probability, but it's a non-zero probability that the crypto implosion does spill over into U.S. equities, and I say that because history has shown that a margin call in one asset class is never just isolated to one asset class. Now, I made the parallel to 2008 not because I think a great financial crisis is coming, but if you were to look at when Lehman filed in 2008, the market actually didn't respond until a week later. There was a lagged response to what ended up being a systemic event with hindsight, but not coincident as Lehman was filing. It sounds like you follow the crypto space fairly closely, TX. I'm just curious to hear your take on if there's any chance that what's gone on recently with FTX, with crypto in general, if there could be a systemic event that's looming, it's just looming with a delay.
Well, I don't think you can rule it out, certainly. If we've learned anything in the last few weeks, it's that we don't actually know all of the counterparty exposure in this market. And when people say that their business is fine, there's literally no reason to believe them. We've seen 3 or 4 different businesses give the dread vote of confidence within days of announcing bankruptcies, liquidity problems, you name it, suspending withdrawals, what have you. So I don't think you can rule those things out. Some of the biggest investors in FTX are also investors in the traditional finance, sectors. Tiger Global is one of the biggest investors in FTX. Sequoia Capital, Temasek, there's Paradigm, there's a bunch of other investors there who have exposure to other things. Digital Currency Group, they have a bunch of companies under their web, including Grayscale, and they are exposed to Genesis and what's going on there. And Genesis just apparently, according to news I saw earlier, is trying to find a $1 billion emergency loan by Monday. So I think that there's some meat on that bone, Mike, about the delay in the response to a major insolvency event and whatever counterparty exposures there are. I think those things are going on behind the scenes now. It's been a week since they filed for bankruptcy, almost a week. And maybe next week is when we get real clarity. I think we're in the heightened part of the rumor chaos here. We probably will through the weekend, especially since crypto doesn't stop. But I think that there is risk there. I'm with you though. I don't think it's a great financial crisis level event because I don't think someone of Lehman Brothers' size is about to collapse or anything like that. That was hundreds of billions of dollars. I have likened this FTX event to crypto's great financial crisis. We thought it was the Three Arrows Capital collapse earlier this year when we found out how much uncollateralized debt that they had. But it turns out it may have been FTX all along, considering how much exposure they had, how much irresponsibility they'd used with various funds, and how many different people had invested in them. I think we even have Canadian teachers' pension funds exposed to FTX. This touches everything. Tom Brady and Gisele Bündchen lost presumably hundreds of millions of dollars. So there are more shoes in this saga to drop, I would have to say, but I don't think it's Lehman's size in scale.
Yeah, no, I think you're hitting it exactly right. It's sort of the question is it a butterfly effect, right, to everything else, right? And when you're in a highly levered system, those butterfly effects get more pronounced in terms of the chaos that can ensue afterwards.
Sure. That's the eternal struggle, isn't it? To try to find people who are not full of shit. Because there's a lot of grifters out there. And we're on the backside of an historic everything asset bubble. So there was a lot of grifting happening in every market. And this is definitely a learning experience for a lot of people, even people who thought they had everything figured out. Myself included, there's definitely a lot of things I've gotten wrong. I know Michael would agree himself as well. So there are a lot of people who have had models, have had an understanding of the world that has been true for 40 years. And suddenly they're finding that their way of measuring things is not necessarily working, right? For whatever reason, their model has broken or it needs to be adjusted. And that's happening kind of to everyone all at once.
But on that point, the problem also is that, and this is where I think it's important to not follow people that have this mindset. The problem, at least that I see, and I'm on the receiving end of it, is people are not able to distinguish the person from the problem and the cycle on top of that, right? As to why things are seemingly broken.
Exactly. Why things are broken. And I think that you can, once you find people who are attuned to the market outside of their specialty, like there's a lot, for what I'm trying to say is there's a lot of traders, particularly in the crypto space, who only focus on trading their, shit coins of choice. And they don't pay any attention to the outside economy. They don't pay attention to interest rates. They think macro is BS. They don't think any of it matters. And they think that there's some idiosyncratic flow into crypto. And all that they have to do is look at what's happened for the last, 5, 6, 8 years. But those are the people who are going through the learning experience now. Those are the folks who are learning that there are factors that exist outside of their myopic view that are impacting their results. And I just think that if I had to give advice, I can't give specific advice because I think it's unique to each person. You got to find someone who resonates with you. But the people that I follow and learn the most from are people who remain humble about the future, who do not speak in absolutes, but rather speak in probabilities and frameworks, and people who seem respectful that macro is currently driving the bus and that the trends of the last few years in a raging bull market are not necessarily apt at this current time. There's a lot of people still learning that. Like they can be right in a vacuum. And it's something we said earlier when we were talking about day trading. You can be really myopically laser focused on a tiny piece of the market on an intraday basis, and you can be right about the direction of it and what happens, and still know absolutely nothing about the greater environment around your little piece. So those things can exist at the same time, which is tricky.
And you can be right with just a 1% position. I mean, the other thing is that people talk, right? No, really, it's like people talk in terms of, oh, look at this trade, I'm so good, and like they put like a very small position. It's like, all right, first of all, the reality is most market movement is compressed, right? This idea that there's consistency is nonsense, just given distributions, right? When you look at market history, but this is where I think Twitter does become toxic, and I share that frustration, Gio. And again, I'm from the receiving end of it. Even me saying that the probabilities are changing. I said melt up October 2nd. Now people are like, oh, what up your melt up? Okay, I said October 2nd, and now I'm the first one out there to say, okay, now it's not as clear. And I'm saying that because I'm giving voice to signals. But nuance is hard to get across, unfortunately, I think, in a medium like this, where I still think, TX, I'm curious to hear your thoughts on this too. There's this almost mentality still of it's me, the FinTwit person, against every other FinTwit person, as opposed to collaboration, which you can find, but gets harder when people are emotional.
It does get harder when people are emotional. Everyone's trying to protect their bags, and at the end of the day, all of us are really just in service to ourselves and the money and the money that we can influence and the people that we can influence, our little circles. But it's difficult to try to exist in a world where long-term trends are changing. And, if you just look at a lot of these macro FinTwit experts, a lot of their charts don't even go back more than like 1990. It's really hard to find insights about the current time when you don't even look at a prior inflationary period. So I think that there's still just there's a lot of adolescence in this space, particularly in the last few years, as a lot of people have joined the markets for the first time. And maybe they've found success with a unique little trading strategy that paid off in the bull. And now they find themselves floundering because they haven't taken the time to learn some fundamentals about markets. And that's a major disconnect that happens in every bear market, by the way. This isn't unique in that regard. It's just many people are now experiencing it for the first time. Now, it's an interesting question, and I'll be forthright that I'm definitely not an energy expert, and some of the people listening to me now, I know more about it than I do. But the dollar strength is, in a way, feeding upon dollar demand. And Brent Johnson talks about this a lot with it. He has a great model, the dollar milkshake theory, and we're seeing a lot of that play out this year. And it's pretty interesting. I did some research on dollar invoicing and world trade. And what I found that's really interesting is that the dollar is becoming more and more ubiquitous in world trade. Even as there are people claiming that the dollar is about to die, it's becoming more and more popular. The percentage of countries who invoice at least half of their imports in USD is more than 50% of all countries, according to the data. There are, like in the EU, for example, they have a lot of granularity on this data. The EU pays for 50% of its imports in USD, even though the United States is only one of their trade partners. I think over 80% of their petroleum products are paid for in USD. There are countries like Malawi that has extensive trade details. They have a lot of really good detail about their invoicing. They pay for 90% of their imports from Asia in dollars. The United States isn't even involved in those transactions, yet our currency is 90% of that economic activity. And those things, as well as the ubiquitousness of dollars in firm financing around the world, you can get dollar loans from banks in Europe. Like those have created a more ubiquitous currency, but it also creates a feeding mechanism that as it gets stronger, it hardens liabilities across the board in that currency. And I did some research, and one of the things that they found, there's a pass-through effect on inflation. And if you have a number of your imports denominated in a currency outside of your own, it has a pass-through effect on your domestic inflation and your domestic prices. And the dollar has an outsized impact compared to other currencies on the pass-through effect because it is so common. It's a couple basis points higher in percentages of the effect it has on inflation for domestic countries that are importing in dollars but don't have the magical dollar money printer. So I might be answering your question in reverse, to be honest, Dirk, because I think you were asking me if this dollar strength is affecting domestic inflation here. I don't know if I have a good answer for that. I'd probably want to think about that some more. But I can say definitively that a strong dollar is probably contributing to inflation in many other countries who don't have the power to manage their access to dollars, but need it to buy important resources. Well, historically, the market bottoms several months after an official recession is called. I think I tweeted something yesterday. You could find it in my feed where I showed the fractal of all of the official recessions going back about 70 years. And the bottom of the market is in the middle of that period of time in every instance. And there's a couple of things that have happened with virtually 100% accuracy, which is practically unheard of. But the SOM rule basically states that unemployment never rises more than 0.5% in a year without there being a recession. That has happened every single time going back to the middle of last century. When unemployment has risen at least 0.5%, we've had a recession. And then combine that with what I just said, the market bottoms in the middle of a recession every time. So when we have these two things, that leads me to have a base case that we have not seen the bottom yet, that we will not see the bottom until the Fed hikes enough that we actually see softening in the labor market. Now, they believe that labor can simply see job openings reduce without causing widespread job loss because we have so many job openings, and that is their path to tightening labor without causing a blowout in unemployment and a recession. But if you look at the summary of economic projections that the Fed put out in September, they list a 0.7% jump in unemployment from now to the end of next year, and they don't think it's going to cause a recession. But I just said that 100% of the time it does. So I have to believe that they're going to hike us into one. I believe that the SEP is a tacit admission that a recession is a lock, basically, because they perceive the risks to the upside in inflation as higher than the risks to the downside. They've stated, just in the recent FOMC, they stated supreme confidence in their tools and their ability to rescue the economy should they push us into a recession. Alarming amount of hubris and trust in their ability to rescue the economy. But I say all of that because that informs my base case that we haven't seen the end yet. If you go back to what I said at the beginning of the call, Mike Kantrowitch's hope cycle, we've seen housing slow down, building permits, housing starts have slowed down. We've seen ISM new orders slowing down. They're in contractionary territory, but we haven't yet seen earnings fall, and we have seen no movement whatsoever in unemployment. And we may not see a movement in unemployment for a while because of just some changes going on in the labor force. But long answer, the TLDR is I don't think that we're going to see a bottom for several more months, at least.
Everybody, I shared in the nest, it's TX's pinned tweet. If you're curious to get access to his premium newsletter, you can click on that and sign up. As you can tell, very thoughtful in the way that TX frames things here.
I think there might be something to that, Kevin. It's certainly, I think most would agree it's hard to quantify that. But, but also the kind of mania that we see in the market, the kind of desire to manipulate price in a beneficial way, like those tendencies have always existed. There have always been meddlesome actors in markets, even long before social media existed. People would manipulate the newspapers, when that was the primary source of information. It just, those things happen on a slower lag. I think that you could argue the acceleration of access to information might play a role to a degree in the movement of markets, like when intraday news is announced and you see it get responded to immediately, not just from algo bots, but from people on Twitter who catch the squawk. Like that, I do think there's a factor there. And when we send everyone home from COVID and we've now created this remote work revolution where no one wants to leave their house anymore and everyone wants to just play on the internet all day, I think that there is something to that. I don't believe necessarily that it's fundamentally changing the behaviors of the markets. I think that they have played out in a relatively similar way to the way they do in prior bears. Not the correlation across assets, but just way price is breaking down and falling over and the volatility that expands as it does so. I think much of that is very hallmark bear market. And the bull, likewise, was very hallmark bull market, low volatility, persistent rises in price, short pullbacks. Those things are always there. And there are always players trying to manipulate the mob to achieve price outcomes that benefit them. So those things are always there. Maybe they're slightly more amplified and easier to access now. But likewise, the people who actually move the markets and who make things happen in the markets at scale, those people aren't making decisions necessarily just because of Twitter. They have information we don't have. So I don't know how much of a factor it is, but it is interesting to think about.
No, and thank everybody for joining and participating and helping to ask questions. Everybody, please make sure you follow TX here on Twitter. I will have this as a podcast, and everybody enjoy the rest of your day. Thank you, TX. Really do appreciate your knowledge and time here.